Hey everyone, welcome back to Corporate Decoder. Today we're diving into Bank Financial Corporation's latest quarterly report, and let me tell you, it's like trying to decipher a financial lasagna. Layers and layers of numbers, but we're here to pull out the tasty bits. Did their profits rise like a perfectly baked cake or fall flat like a drop souffle? Let's find out. Alright, this is their 10Q, which is basically a checkup report that public companies have to file with the government every 3 months. It tells us how they're doing financially. Think of it as a financial heartbeat, showing if the company is healthy, getting stronger, or needs a little help. This report is for the quarter that ended in March of 2025, so it's a snapshot of their performance from January to March. Bank Financial is a Maryland-based corporation. That's a fun fact. What's more important is that they trade on the NASDAQ stock market under the ticker symbol BFAN, if you want to check their stock price while we talk more about their situation. As of late April 2025, they had about 12.5 million shares of common stock outstanding. This number matters because it's used to calculate earnings per share, so how much money the company makes for each share of stock. Now let's skip ahead to the good stuff, the numbers. Their cash and due from other banks is around $20 million, which is quite constant. Their interest-bearing deposits in other financial institutions jumped significantly, from $64 million at the end of last year to $124 million now. It means they are putting their money into those sorts of assets. Loans receivable is $841 million, but there's also an allowance for credit losses, about $7.3 million. This is money they set aside to cover loans that might not get paid back. It's a rainy day fund for bad debts. On the other side, we have liabilities, or what they owe. Their deposits are at $123 billion. These are customer accounts, checking, savings, etc. They also have some borrowings at 15 millions, etc. They also have some borrowings at 15 millions and subordinated notes at around $18 million. Finally, their retained earnings, the profits they kept to reinvest in the business, are $74 million. Their interest and dividend income, which is mainly the money they make from loans, is $16.3 million. It's down about $1 million compared to last year. It means something isn't as profitable as before. Interest expense, what they pay out on deposits and borrowings, is about $4.8 million. This is the same as last year. So their net interest income, the difference between what they earn and pay, is $11.5 million, down from $12.5 million. That's something to think about. They actually recovered some money from credit losses. They are getting some money back. Good news. Non-interest income, things like fees for services, is $1.6 million, a slight bump from last year. Not bad, not amazing. Non-interest expense, the costs of running the bank, is $10.9 million, down almost $1 million from last year. It seems they are cutting costs down. Finally, their net income, the bottom line, is $2.1 million, up from $1.7 million. Better than a stick in the eye, but it might not be sustainable if their revenue keeps trending down while their expenses keep trending down. Earnings per share, EPS, which tells you how much profit each share of stock gets, is at 17 cents, up from 14 cents a year before. It also confirms that they had more profit. Let's look at one more metric that tells you about the real profit. This is because unrealized gains from securities that they hold can tell us a lot about the company in the future. Here it says net income is $2.1 million. And if you add unrealized gains from securities, you get $2.4 million. This means some of the comprehensive income is related to how their investment in securities are going up or down. The fair value gains and losses from securities, which is important data as they can add a lot of flavor to a company's situation and risks. Total fair value is $357 million. Quite a big number, but the most important numbers in these tables come below. Here you can see if their bonds are doing well. Gross unrealized gains and losses tells you what they could have made if they sold right now. These are gains of $112,000 and losses of almost $500,000. It means their bonds didn't do so well. That's something to pay attention to. Looking at debt securities, they hold way more in less than 12 months at $109 million. This means that if these bonds turn bad or there are problems with the debtors, things could turn sour really fast. Quick check on the loans portfolio with some of their loan qualities. They have almost $500 million in multifamily mortgages and around $100 million for non-residential real estate. They also have roughly $220 million in commercial loans and leases, which can be a mixed bag of risk in different businesses. But it looks like they're estimating $723 million in credit losses, which is important. A lot of the loans are fine, but about $21 million are shaky, with a huge $5 million in partial write-offs, not a good number. Cash flow change, good for them, up $59 million. Okay, now let's quickly touch on some accounting rules that are changing. Basically, they have to start giving more detailed disclosures for income taxes and expenses. It's just to make sure people know exactly where their money is going. The loans receivable is quite important as it tells you a lot about their risk. Now onto the allowance for credit losses. You can see if they are preparing enough for potential loan loss. Here they are accounting for over 7 million. They are quite responsibly predicting the future, or are they? They did have a fair bit of loans that were past due, but those that did not have accruals made up most of the debt with only a few thousands. Their loans are doing reasonably okay in this segment, so no bad news. Here's the unrealized loss position, $37 million US Treasury bills and notes. And some other government-backed securities are in the red. This means that they would lose $459,000 if they sold. Are these secure or shaky? The team is categorizing the bonds based on quality, pass or special attention. It's mostly passing, which means the sky isn't falling. More fees. You can take a look at the sources where the profits are coming from to determine if they are reliable and consistent. Finally, we end with the legal proceedings. Everything is fine and all the legal proceedings they face are manageable. Now, what does this all mean? Bank Financial seems to be navigating a pretty challenging environment. Here is my view as a summary. Their interest income is down, their expenses are too. So you could say their expense management is quite good. Their asset quality has some concerning parts. Some loans have bad risk scores. It is concerning. Bank Financial is in a tough spot, like most of these regional banks. So they need to make hard decisions about lending, expenses, and what kinds of services will give them an edge in the market, and it's worth keeping an eye on whether their actions result in actual income and improvement in debt. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. See you all next time.